Welcome back to The Explainer. So, have you ever wondered how massive institutional traders and market makers actually sleep at night when there are literally millions of dollars on the line? I mean, most retail traders spend their time agonizing over a single question. Is this stock going to go up or is it going to go down? They're relying entirely on guessing market direction. But what if I told you there's a mathematical way to completely strip away that directional risk? No more guessing. Today we're exploring a fascinating, absolutely crucial strategy pulled directly from the trading desks of the world's biggest financial institutions. We are demystifying delta-neutral hedging.
All right, here's our roadmap for today's explainer. 1. The directional risk problem. 2. Achieving delta neutrality. 3. The mechanics of rebalancing. 4. The hidden gamma tax. And finally, 5. Why traders use it.
Section 1. The directional risk problem. Okay, let's dive right into the existential threat options market makers face every single day.
You see, to truly grasp this, we kind of have to flip the traditional retail trading mindset completely upside down. When a retail trader buys a stock, they need it to go up to make money, right? They're essentially predicting price direction. But institutional market makers, they're quoting bids and asks on thousands of contracts simultaneously. If they sell 500 call options, they are effectively short a massive stock position because they're obligated to sell shares if the market shoots up. Just one bad directional move could wipe out months of income. No way they're leaving that to chance. They don't want to care which way a stock moves, they only want to predict how much it moves.
So to neutralize that directional risk, we first have to measure it, and we do that using a metric called delta. Delta tells you exactly how much an option's price is expected to change for every $1 move in the underlying stock. It operates on a scale from -1.0 to +1.0. If you have positive delta, like say owning shares of a stock or a call option, your position profits when the asset rises. But if you have negative delta, like a short stock position or a put option, you profit when the asset falls. Basically, delta is your directional compass.
Section 2. Achieving delta neutrality. Now that we know how to measure our directional risk, let's look at the actual solution. We're going to use delta to strip away that risk entirely. Think of this like balancing a giant scale. If you sell a call option, that gives your portfolio a negative delta of, let's just say, -0.54. You're exposed to the downside. To fix this, you simply add an equal but opposite weight to the other side of the scale. By buying shares of the underlying stock, which give you a positive delta of 0.54, the two positions cancel each other out perfectly. Your net portfolio delta is exactly 0. You, my friend, are officially neutral.
Let's anchor this abstract theory in some concrete math, just to make sure we're on the same page. Standard equity options contracts typically represent 100 shares. So, if you sell a call option that has a delta of 0.54, you multiply that 0.54 by 100. That gives you 54. To neutralize your negative delta, you must go into the open market and buy exactly 54 shares of the underlying stock. It's really that precise. By doing this, you've achieved a state where your immediate sensitivity to the underlying price is effectively 0. So what does that actually mean for you? Well, it means that at this exact moment in time, if the stock makes a small move up or a small move down, the overall value of your combined position will barely budge. It gives you a moment of complete peace. The gains in your shares will perfectly offset the losses in your option, and vice versa.
Section 3. The mechanics of rebalancing. Now, if the market just froze in place, we'd be done here. But the market never stands still, does it?
Prices constantly shift, which means our perfectly balanced scale is only ever temporary. To understand why that perfect balance doesn't last, we have to introduce another metric into the mix, gamma. Gamma is the rate at which your delta changes when the underlying stock price moves. Think about it this way. If delta is the speed of your car, gamma is the acceleration. As the stock price shifts up or down, gamma changes your options delta, completely throwing your carefully calculated 54 shares out of whack. The scale inevitably tips, and it requires your immediate attention.
This brings us to a highly actionable continuous loop known as dynamic hedging. Let's move through how this builds. Step 1, you compute your delta. Step 2, you buy or sell shares to offset it, just like our 54 shares example from earlier. But then, step 3 happens. The stock moves, and thanks to gamma, your options delta changes. Suddenly, you might need 60 shares to be neutral, but you only have 54. So, step 4, you have to rebalance by buying 6 more shares. And finally, step 5, you repeat this process over and over again for as long as you hold the position.
This constant cycle contrasts sharply with what's called static hedging, where you basically just set up a hedge once and leave it alone until expiration. Static hedging is cheap, sure, but it's incredibly inaccurate if the option is anywhere near the current stock price. Dynamic hedging, on the other hand, involves continuous rebalancing. It is highly accurate, but it comes with incredibly high transaction costs. However, for market makers managing massive portfolios, dynamic hedging isn't just an option, it's an absolute requirement to survive.
Section 4. The hidden gamma tax. Because this survival mechanism, it comes at a steep price.
Let's peel back the curtain on the harsh realities of maintaining this constant delta-neutral shield. Consider the mechanical flaw of rebalancing. As one trader from our sources puts it, and this is a great quote, "You're systematically buying high and selling low." Sounds crazy, right? But think about the math. When the stock price rises, your short call options delta becomes more negative, so you literally have to buy more shares at that higher price just to stay neutral. When the stock falls, the delta decreases, forcing you to sell shares at a lower price. You are structurally forced to buy high and sell low. Traders refer to this bleeding cost as the gamma tax. It's just the necessary price you pay for absolute insurance against directional risk.
And honestly, that gamma tax is just the beginning of the real-world frictions that eat into a trader's profits. Every single time you rebalance, you're paying transaction costs, like commissions and the bid-ask spread. Plus, you can't physically hedge every single millisecond, which leads to discrete hedging errors. But the absolute most terrifying risk for a delta-neutral trader, jumps and overnight gaps. If a stock closes at $100 and opens the next morning at 80 on bad news, no amount of dynamic hedging can save you from that gap. You also face what's called pin risk, that chaotic unpredictability if the stock price hovers right at your strike price on expiration day, leaving you frantically adjusting shares right up until the final bell.
Section 5. Why traders use it. Which naturally leads us to a pretty pivotal question here.
If maintaining a delta-neutral position is so mentally demanding, literally forces you to buy high and sell low, and carries massive hidden costs, why do the biggest, smartest market players rely on it every single day? Well, the true profit engine is right here. Delta hedging itself isn't what makes the money. It's what isolates the risk so you can make money elsewhere. When you sell an option, you collect a premium that's based on implied volatility, which is how much the market thinks the stock will move. While you hold that position, you safely collect theta, which is the value an option loses every single day just from time passing. Think of it like a melting ice cube. Every day you hold that short option, it loses a little bit of value, which is pure profit for you as the seller. As long as the stock's realized volatility, how much it actually moves out there in the real world, is lower than the implied volatility you initially sold it for, the daily time decay you earn from theta will completely outpace the gamma tax you pay to hedge. You are essentially betting on volatility being overpriced and entirely ignoring direction.
And this brilliantly engineered strategy scales across literally all levels of the market. Market makers use continuous delta hedging just to survive. They just want to collect the bid-ask spread without blowing up their accounts on some wild price swing. Massive volatility hedge funds use it at a portfolio level to isolate volatility, profiting purely on the math of implied versus realized movement. But even everyday retail traders apply these exact same principles in simpler, less demanding ways. Strategies you might already know, like covered calls or cash-secured puts, those are just basic forms of reducing directional risk using delta.
Delta-neutral hedging really proves that true market mastery doesn't come from a magical ability to predict whether a stock will go up or down. It comes from understanding the mechanics of risk, isolating the variables, and manipulating the math to your advantage. So the question to leave you with today is this. In your own trading journey, are you going to keep throwing darts and betting on direction, or are you ready to look deeper and start trading volatility? Thanks so much for joining us on this explainer, and we'll catch you next time.